Every receipt, bank statement, and dividend slip that you generate is now immediately parsed into digital data. The Income Tax Act 2025 mandates reporting for secondary streams that previously flew under the radar. If a bank pays you, the system sees it. This creates a specific choice for your next return. You can trust the pre-filled data provided by the tax portal or take on the friction of a manual reconciliation. View this choice as a simple ROI calculation. You are trading 60 minutes of auditing today to avoid months of bureaucratic entanglement later. These strict matching protocols are part of a systemic upgrade directed by the Finance Ministry. Automation hasn't removed your liability as a taxpayer. It has simply made catching your mistakes automatic. The income tax portal is built around a specific promise: a seamless, pre-filled, one-click filing experience. The actual data flow is far less streamlined. Banks, brokers, and employers all individually push their own numbers into the system on different schedules. All of this third-party reporting aggregates into a single repository, your Annual Information Statement, or AIS. Distinct streams of data from your employer, your broker, and your bank all funnel down into this central AIS node. If the portal detects a discrepancy between this aggregated data and your submitted numbers, it triggers an automated 143.1 mismatch notice. Relying solely on the portal's pre-filled forms means abdicating your financial responsibility to third parties. A manual audit is now the highest ROI task of your entire year. The first major trap is ignoring micro-incomes to save time during the filing process. Taxpayers often skip savings bank interest, small fractional dividends from mutual funds, and interest on previous tax refunds. This usually happens because of an assumption that these amounts are too small for the government to track. Under the 2025 framework, the AIS reports these micro-incomes directly to the portal, making that assumption incorrect. We can map the cost of this behavior on a matrix, weighing the effort required against the impact of getting a notice. Skipping your savings interest takes almost no effort, but it lands in the high-impact zone for penalties. Ignoring these amounts guarantees an automated compliance notice, regardless of the size of the discrepancy. The second major trap is downloading the AIS early in the season and trusting it blindly. The AIS frequently contains duplicate reporting, where multiple bank branches report the same transaction, artificially inflating your perceived income. It also suffers from late updates, as employers often revise their Form 16 data well into the filing season. Look at this timeline mismatch. On the top track, a taxpayer downloads AIS in April. On the bottom track, the employer updates data in late May. Filing based on that early download creates a numerical gap in the system, underreporting your income. Treat the AIS as a living draft document, not a final invoice to be blindly accepted. The third trap is forcing complex financial data into ITR 1 just to finish the filing quickly. Specific thresholds instantly invalidate the use of ITR 1. If you have capital gains, hold foreign assets, or report business income, you must move to a more complex form. This comparison matrix shows the strict input limitations. ITR 1 rejects capital gains and freelance income entirely. You need ITR 2 or 3 to accurately declare those assets. Forcing the wrong form triggers a defective return notice. This invalidates your submission and resets the entire process. Form selection is the structural foundation of your return. Taking a shortcut here makes the rest of your data useless. The solution to these traps is a dedicated 1-hour ITR audit. You need 3 inputs: a freshly downloaded AIS from late May, your finalized Form 16, and your original bank statements. Physically cross-reference the numbers across all 3 documents to ensure your inputs align with what the government expects. Trading 60 minutes of your weekend ensures there is near zero risk of an automated mismatch. Leaning into this brief, high-friction task is the only way to bulletproof your financial life against the automated matching system. The depth of your audit depends on your taxpayer profile. For a beginner profile, 1 employer and 1 bank account, you still must verify that your savings interest matches the AIS exactly. For the optimizer profile, handling investments or freelance work, a line-by-line reconciliation is mandatory. These matching protocols represent the top-level fiscal policy of the Finance Ministry, which now demands exact compliance on every line item. Treat pre-filled data with skepticism. Sit down, do the work, and ensure your filing is accurate. Your manual verification serves as the final defense against a tax system that is now fully automated. For decades, the Indian Income Tax Department operated through stacks of physical paper. Today, under the 2025 and 2026 digital filing frameworks, the ITR Bhavan's authority is enforced by a massive network of interconnected data servers. Many taxpayers still approach filing their income tax return as if it's a rough draft. You gather your main salary slips, guess a few of your secondary expenses, and hit submit, assuming a close estimate is good enough. The tax department no longer relies on human clerks to spot-check your math. They use highly automated algorithmic verification systems that cross-reference every single number you type against millions of existing financial records. These algorithms look for exact numerical matches. If a single digit is off between what you report and what the bank reports, the system automatically flags your profile, freezing your refund and triggering a scrutiny notice. Keeping a clean tax record requires you to proactively hunt down and neutralize 5 specific data friction points before you click that final submit button. The first major trap is omitting secondary income streams. It is incredibly common to accurately report a primary salary, but conveniently forget the freelance gig, the small side business, or the capital gains from a quick stock trade. This mockup shows the government's Annual Information Statement, or AIS. You absolutely must check these rows for interest and dividend entries, but blindly trusting this document without cross-referencing your own bank statements is a massive risk. Banks sometimes delay their reporting or upload duplicate data to the AIS. Even if the error originated with your bank, you are legally responsible for identifying that discrepancy and correcting the figure on your tax return. The third major friction point is selecting the wrong tax form based on your income complexity. Earning over 50 lakh rupees, holding directorship in a company, or owning foreign assets immediately disqualifies you from using the basic ITR-1 form, forcing a switch to a complex document. Guessing your form or omitting small income streams guarantees that the automated system will instantly reject your filing. The fourth error involves the paper trail. Taxpayers often try to lower their burden by claiming house rent allowance and Section 80G charitable donations without actually possessing the physical receipts to prove it. The system tightly cross-checks rent payments. If you claim HRA by paying rent to your parents, your tax file electronically links to theirs. If they fail to report that exact rent as taxable income, the system flags the one-sided transaction. The same rigid logic applies to 80G charitable deductions. The tax department requires a specifically formatted institutional receipt with the charity's registration details. Otherwise, the claim is entirely invalid. Any deduction you claim must have an identical, verifiable mirror image in the government's database, or it will be automatically denied. The fifth mistake is failing to reconcile your draft. This split screen aligns your draft ITR with the government's Form 26AS. If an employer typos your PAN, it disrupts this match, leaving you short. Capital gains must also perfectly match broker data on that same 26AS. For tracking TDS and capital gains, Form 26AS is the absolute source of truth. Any deviation from its records triggers an immediate automated audit. Filing your taxes successfully requires treating the process as a strict data verification task, rather than a year-end guessing game. As you can see on this checklist, the methodology is simply to slow down and reconcile, report all secondary income, verify your AIS against your own records, select the correct form, secure physical proof for your deductions, and make sure your TDS and capital gains match Form 26AS. If you are watching this and realize you have already submitted a return with one of these formatting errors, you can file a revised return to correct the data before the department issues a formal notice. And if you are already dealing with an active tax notice, check the pinned comment below for our step-by-step video guide on exactly how to respond and resolve the issue. Accountant for specific financial advice.